Hey, what's going on, everybody? Working Man's Podcast. James Hollingsworth is coming back to you tonight, this evening, whatever you want to call it. And we have a hot topic. It's basically going to be kind of an introduction to some more content that we're going to be rolling out. And I did mention, I want to say last week, maybe on Saturday, when myself and Deja was on the podcast about a couple people that I'm working on, bringing them onto the podcast, onto the show. And one particular guy is going to be in the investment spectrum, talking about stocks and things like that. And we probably might even touch on a little crypto. But tonight, I'm going to come to you with what I'm calling this is stock and crypto investing 101. Hey, but first of all, if you're watching, because we're coming to you live, man, this is live. It's not pre-recorded. If you're watching via YouTube, you know what to do. Press that subscribe button and also press that notification bell, ring that bell, so you will get notified when we upload new content and upload new videos. Also, press that thumbs up like button. Come on, start pressing that thumbs up like button. Let's get this algorithm going, right? And if you're watching via Facebook, you know what to do as well. Press that heart. Show your brother some love. I feel the love. Yeah, and press the thumbs up button as well. If you do press the angry emoji, would you please drop some comments below and let us know why, what's going on, why you're feeling like you're feeling angry and stuff like that. You feel me? And share this video, man. If you haven't watched some of the other videos, go back and start checking them out. They're right here on the Facebook page, as well as you can go over to YouTube on the Working People's Podcast, and you can watch those videos and share them, because this is content and information that we all need to talk about. And so with this topic, and I know I'm going to once again probably put my foot right in my throat, but I'm just trying to hope you. I'm just trying to hope you, man. You know what I'm saying? I'm just trying to hope you. So I want to talk about, some things with stocks, some basic stuff, because one of the things that really it just kind of rubs me the wrong way is when I see people and the basis of their investment philosophy is, hey, y'all better buy such and such a thing right now, because if you don't, because you buy it while it's low. Don't you know that's what you do? You buy low and you sell high. Man, come on now. If that's the extent and the comprehensive comprehensive development of your investment strategy, stay away from me. Like stay away from me. If that's the extent, that's the full extent of your investment knowledge and your investment strategy is buy low, sell high. And that's it. Stay away from me. Don't give me no advice. And so I'm going to say it again, because I say it all the time. Educate yourself, man. Look here, brothers and sisters, everybody. Educate yourself. Number one. Number two, educate yourself. And number three, educate yourself, because if you don't, somebody will be just saying some stuff and it sounds good, and you'll be getting bad advice and you won't know it. You'll think it's good advice. You'll follow it. And guess what? If you start losing your shoes and shirt, guess what the tendency for most people to do is? To keep diving and digging that hole deeper and deeper. It's kind of like people do when they go on the boat and start gambling or whatever. They lose a little money and they all of a sudden want to try to get it all back. And you end up in a lot of cases when you're doing that, losing more money. So educate yourself. So then, even if you hear some good advice, you will know that it's good advice and you won't think it's bad advice. And you'll be like, he don't know what he's talking about. Look, if it's sweet, if it's tasting too sweet, man, it probably don't have much nourishment to it. And some people's investment strategy to me is equivalent of going to the gas station right now and putting 85 cents worth of gas in your car and think you're going to drive from Chicago to California. Or, your heart and you spit and think that spit, you're going to go over and spit on the elephant and knock it down. That's the extent of so many people's investment strategy. And I'm telling you, some of this stuff is absolutely foolishness, man. Just straight up foolishness. I know you ain't going to like me tonight. And it's cool with that. And I'm probably going to put my foot way down in the back of my throat. But I'm just trying to help you. So let's talk about this. When it comes to investing in stocks, crypto, whatever, places, and I'm going to tell you, I'm going to finally say probably publicly some of my apprehensions about crypto right now at this particular time, and it has been the same. It hasn't changed. So when people start asking me, what do you think about crypto? You invested in crypto? And I'm like, I'm staying away from it. There's a reason why, and I'm getting a little ahead of myself, but there's a reason why Warren Buffett said that if you offered him all the crypto in the world, he wouldn't buy it for $25. Warren Buffett. So look, if you're going to be investing in stocks, now when we talk about stocks, we're not talking about mutual funds or any type of things like that. We're talking about any type of individual stock, that's traded over the stock market, Dow Jones Industrial Average or whatever. It could be some type of stock that's based off of one of the what do you call it? One of the indexes or whatever the case may be. Or in this case, we're going to also include crypto. If you're doing that, you need to have a minimum. Hear me when I tell you this. You need to have a minimum of 5 strategies that you have effectively worked and that you have become proficient at. You need to have 5 investment strategies. And those strategies will be unique. They will be, based on your particular style of investing, based on your risk, your risk tolerance. Me, I have a pretty high risk tolerance. Not crazy wild, I'm not like stupid, but I'm pretty still practical with some investment strategies. But you need to have at least a minimum of 5 different investment strategies. And like I say, that those investment strategies, one of them can't be buy low and sell high. That's not an investment strategy. It's not. And if you think it is, no, it's not. I'm just trying to tell you, it's not. You need to have a minimum of 5 different investment strategies that you can reach in your pocket and grab out at any particular time based on market activity, based on, what your goals are, based on what type of investment that you're investing in, right? You need to have at least 5 different investment strategies that that you've developed, or you maybe copying off of somebody else that you learned it from, whatever the case may be. You may have read a lot of Warren Buffett stuff, and so you might kind of, ascribe yourself to his particular type of investment strategy. Whatever it is, you need to have at least 5 different investment strategies that you can reach for and grab and go down in your pocket and pull it out any given time. You also need to have an exit strategy. I'm not labeling this 1, 2, 3, 4, 5, nothing like that. These are just some particular basics and things that you need to know. And these types of things will be a part of your investment strategies or a collective. Some of them won't be some in one particular strategy. Some will be in another strategy, right? But pretty much with everything, every strategy, you should have some type of exit plan, whether it's a long strategy or whether it's basically a short-term strategy, something that's a 12-month strategy or less. Or if you got a day trading strategy, whatever the case may be, you need to know what your exit plan is. And here's the problem with some other type of people when they start saying, well, this is how they go about investing. They just buy everything and think they're just going to hold it forever. And it depends on what strategy you're using, right? So if you're using, let me not go there yet. Let me back up just a little bit. But you need to have an exit strategy. It needs to be a part of your system, a part of your plan, a part of your investment strategy, right? You also need to have different skills that you've developed and different strategies that you've developed for leveraging. So this is one of the concerns that I have when it comes to crypto is the inability to really hedge it and leverage it. By hedging, what I mean is investing in other types of derivatives or things that can offset your position in it. So if the only position that you can hold in it is an appreciation type position, or the strategy of appreciation, and you can't hedge it, then you can't really defend yourself against losses, especially for investments that trade 24/7 around the clock, right? And then therefore that hampers and that really takes away your ability. If you truly are day trading, then you need to have a time of the day when you are either getting out of it or you are deliberately saying, I'm going to hold this for 2 days or 3 days, whatever that strategy is. But it still includes having some type of exit strategy to get out when you're trading it. Because the danger of holding something that's being traded 24/7, 24 hours, 24/7, 24 hours a day, 7 days a week, is when you go to sleep, unless you plan on not sleeping, when you go to sleep, you don't know what that thing is doing overnight. So you need to have an exit strategy, and you need to have a plan on how you're going to leverage whatever your investment is, right? You got to have some type of leveraging strategy, some type of hedging strategy. And here's another thing is if you're doing some type of really short strategy, day trading, or some other type of really short term type strategy where you're going to have some short term capital gains and stuff like that, you need to be able to leverage that position some kind of way. And you need to be able to not allocate, but you need to be able to, because usually short term strategies, just like long term strategies, include some type of initial buy in and then periodic buy-ins. And what people tend to do on a long strategy is a lot of times they will allocate a dollar cost average type strategy where they are systematically investing a specific amount at certain times that they've already allotted. And those times really don't particularly change, right? But when you're doing more of a short strategy, it's more like you're buying in at just random times based on the dip. So if you're looking at that particular stock and you're looking at the dip, but here's the thing that most people don't do, and this is why I have a problem with people that start screaming about you need to jump on crypto, you know. And let me go and say it first, and then I'll back up and say what I was about to say. Is buying on this dip, you got to be able to calculate your cost basis, because if you buy in at an initial amount, it goes up, then it dips, you buy in, right, at this whatever amount, but maybe it's not. It's still 10%, 20%, 25% over what your initial buy-in was. You just raised your cost basis. So you can be up that day, but you can still be down overall based on what your cost basis is when you bought back in the second, third, fourth, fifth, or sixth time. And that's what people tend to do with short-term investment strategies, whether it's stocks or crypto. They keep buying in at these random, just whatever times it just feels good or the price looks good, and they're raising their cost basis. And most people don't have a clue what their cost basis is, right? So that is something that you need to really be concerned about. What is your cost basis? And if you're going to do some type of short strategy, especially as it relates to crypto, let me address some other concerns that I have and issues with it. Is when you're talking about an event. Well, let me say this first. Back in the day, old school, old head investors, people that's been around the investment landscape for a while, we already know. Nowadays, people don't really go and buy newspapers. They don't really go down to the newsstand or the stand back on the street where somebody was selling candy and magazines and had the newsstand and the newspaper, the daily newspaper, right? The New York whatever the name of the New York, I can't even remember the name of the doggone paper. Or the St. Louis American, whatever the paper is, the Flint Journal. Look, us old heads, the old school and people that's been around the investment landscape for a while, we already know when it hits the newspaper, this is what we always used to say. By the time it hits the newspaper, it's old news. And so many people are using an investment strategy based off of what they're reading in the newspaper. And now that we have social media and the internet up and thriving and a primary source of information, the internet or Google has now become the local newspaper and it's worldwide. But let me tell you something, by the time it hits and it's stamped on Google or stamped or rolling down in a social media type process where you can get on there and swipe and read it, by the time it hits these platforms, I'm telling you, it's old news. So if you are basing your investment strategy off of what you're reading in a newspaper, and if you're basing your investment strategy off of what you saw on Google or what you saw in a internet post, or even if you're in a chat room, there are certain chat rooms that I sometimes jump in just to see what people are saying about particular stocks. And some of the bigger chat rooms, a lot of people are trading penny stocks. So if you're in these rooms and you're in these chat groups and stuff like that, and people are talking about they're doing this, that, and the other, by the time it really catches on and it becomes news that's spreading to the masses, guess what? It's no longer current. It's old news. So you need to have a strategy that can read through what you're reading and be able to project what's to come. So basically, when you're investing and using a short strategy, whether it's day trading or some type of short strategy, you have to be able to predict the weather. You have to be able to predict that it's about to rain before the weatherman says anything, before the news comes on and the weatherman or weather person give their report about what's going to happen next week. You have to be able to already project and calculate through your analysis and through your strategy that it's going to rain before you hear anybody say anything about it based on old news. Or you have to have a process of being able to evaluate and go through a process of analysis on that investment to be able to predict what it's about to do. That's why certain people hedge their positions, right? And that's why with regular stocks, you can short them. And with crypto, you can't short it. So here's another dilemma that you have when you can't hedge your position. You got somebody initially offering this investment. And just for the sake of this live broadcast, we're going to say that James Hollingsworth, the Working People's Podcast, on tomorrow, on Friday, is going to offer shares of knickknacks. Shares of knickknacks. Now, I am the creator. I'm the one who originated this offering, right? So first of all, we need to know that whenever there is an IPO, an initial public offering, stocks, let's use that as an example, it is for the purpose, the company goes public, it is for the purpose of raising capital to operate that business. Here's the issue with crypto. What business is somebody raising this capital for to operate? So when Elon Musk or whoever this guy was came up with this coin, and I don't want to screw it all up, so I'm not going to start naming coins and stuff. He was the holder of all the value in that position, right? And what was he raising capital for? So he can send spaceships to the moon, right? There was no particular business behind the the offering of those particular coin or currency, cryptocurrency, right? So what's the IPO for? What's the initial public offering for? What is it raising capital for? So this guy, during the pandemic, where everybody is struggling financially, he's becoming richer during the pandemic by offering these IPOs, these investment offerings, and holding a major position of value. So tomorrow I'm going to offer knickknacks, but I hold the position of value because I'm the one offering it. So in a regular stock investment offering, they have to do their filings with the SEC and the Securities Exchange Commission, all these filings, and say they're going to issue this many uh, shares of stock at this particular price because they project that they're going to sell this many shares of stock at that particular price, it will raise this amount of money. So same thing, I'm gonna offer this knickknacks tomorrow at a particular price. If I get us, and I'm gonna offer that at such a discounted price where I'm gonna get a lot of people to buy in. So when they buy in, I already have a specific dollar amount that I offered it at. I have a particular specific number of shares, in this case, coins or knickknacks that I'm going to offer. Therefore, I can do the math on my position of value that I hold to determine how much capital I'm going to raise through that offering. Now, that offering will be an initial offering, and then it will be an extended period of time, whether it's a week or a month or 6 months, whatever that time frame may be. It could be 2 days, it could be 2 months, it could be 2 years. It really don't matter. Whatever that time frame is, right, on the subsequent releases of these particular knickknacks that I'm offering, I still hold the position of value. So you're talking about somebody that creates an investment, they hold probably 80% of that value, if not more. Therefore, they control how the needle moves. Once again, I said, if you're not able to move the needle when it comes to investing, and if you're not sitting in a position where you have at least a minimum of $100,000 minimum, you're not going to move that needle. It's like you go into there and you put in $200 or $1,000. That's like putting 85 cents in your gas tank at today's prices at regular unleaded for $5.19 in Michigan, and some places it's higher than that. And then you think that you're going to put 85 cents in your gas tank and you're going to drive from Chicago to California nonstop. So if you can't move that needle with volume and with the position of value as you hold that position, then that person controls the market capitalization. They hold the market. They hold the value to move that. In this case, those knickknacks at whatever price. Then they can liquidate their position. And what happens? Because you can't hedge your position, because with crypto you can't. There's no hedging of it, right? There's no alternate position that you could take in some type of relatable derivative that can protect your position that you're holding to appreciate in value. So then when this person holds 80% of the value and they sell and they start liquidating, say 30% of their position initially, they might, because remember, there's a time frame. Let's say 6 months. So in 2 months, they might liquidate 30% of their position. They just made a lot of money, but it dropped the value of that particular, this case, the knickknacks. It dropped the value of the knickknacks, 10, 15%, 20%, right? So then 4 months from now, I liquidate another 20% of my position that I was initially holding at 80%. Now it drops the value again, but you can't hedge, right? Because there's no derivatives to hedge it. There's no alternate position you can take to hedge your position to protect your position of wanting this thing to appreciate in value, to go up so you can make some money. So then by the time the 6 months come, I liquidate another 40% of my position, and I'm holding, maybe I might hold 10% left, right? Might hold on to a little bit. That's insignificant value at this point. So I've liquidated a major portion of my position of value, and it drives the price down because you can't hedge it. Then the people that was the small fish, the ones spitting at the elephant, hoping to knock it down, end up losing the little bit of money that they probably made because, number one, they didn't calculate their cost basis as they kept buying in at incremental time. I can't even talk tonight. Incremental time periods, right? That was raising their cost basis, and then they held on it too long because they were taking a long position, long strategy on something that was only meant to have a short strategy in order to trade it, try to get your little money out of it, and move on. And here's the problem. The people that I, see talking about crypto and stuff like that, they love it too much. There is no investment that I have currently or that I've ever had that I love that much that I won't dump it in a heartbeat if it's not performing up to the strategy that I implemented for that particular investment. That's why you got to have an investment strategy whenever you move into any type of investment, and an exit strategy, so that if it's not performing up to your strategy and up to your goal or up to your profit margin that you set, you can either liquidate your position or you can dump your position or whatever you want to do. I hope this is helping you so far, and I hope that people watch this video, and I hope that you share it so it can bring some understanding, especially when it comes to the crypto markets. Now, about a month or so ago, I think the date was April, I wrote it down, April 11th, Kevin O'Leary, who's one of the strong proponents of crypto, he did a interview with Kitco News. And in that interview, he talked again further about Kevin O'Leary from the Shark Tank. He talked more about how he wants the government to step in and to begin to what's the word? He began to regulate. He wants the government, big investors. Remember, he's a venture capitalist. He's an investor. These big time investors, the ones that hold some money, right? They want the government to regulate cryptocurrency. And if you haven't seen that interview, you can go on YouTube. It's available on YouTube. It was done on April 11th. Kitco News, Kitco, Kitco News. And in this interview, he talks about the government regulating crypto and backing it by the very thing that some of y'all are saying we want a deregulated financial currency. Well, guess what he is pushing, and many investors are pushing, that crypto gets backed by. Have you figured it out yet? Can you say the US dollar? So the very dollar and the very currency that you all want are saying it's falling apart. The dollar is only worth 94% of its value, and the dollar, the market, it's the US dollar is trash and it's not backed by gold anymore. Where here is big investors, including Kevin O'Leary. And if you don't take my word for it, go watch the interview. Who wants crypto to be regulated? They wanted to have some type of system where you can value it, just like having some type of offering in the stock market. That's a what's the word I'm looking for? That's a you have the crypto coin, but then you have an ETF, or you have some type of stock or some type of investment that symbolizes that coin, for lack of a better term, that this is what you use to track the value of that coin, that whatever you call it. We can call it knickknacks again, right? But they want that coin to be represented by an ETF or some type of stock, some type of whatever. And then that's how we can track it, right? We can track its value the same way we track the market, right? Or same type way we track any other type of investment, other type of stock. So then that stock can begin to be put into a regular portfolio along with other stocks, bonds, and other types of investments, right? You can then put it in a portfolio that still moves and is tracked just like stocks are tracked on the Dow Jones or the S&P 500 or the NASDAQ, whatever the case may be, or some other type of over-the-counter offering system. So along with that, saying he wants this to be backed by the US dollar, right? The same currency that you all are saying that you want crypto to replace. And then also they want it to be able where they can, as investors, they can now go in and lure institutional investors. and they can lure these people in because now they can trade it, they can leverage, they can hedge it, right? You all remember what happened to GameStop, right? GameStop was being held by a huge by hedge funds. Basically, they were holding positions, shorting the stock. So as the stock went down in value, they were making money. But because of all the do-it-yourself online platforms right now, a whole bunch of people started communicating, hey, let's drive the value of this stock up. Let's drive the value. So they started buying, and the volume started going up, which started making the price go up. Volume is what moves a stock, right? Volume moves a stock. So the stock started going up, but these guys were holding short positions that were making money, millions of dollars on the price going down. But all of these people got enough in the market to move it, throwing their money into that, right? But what happened? Other hedge funds and other companies and corporations started throwing money to these people to save them and bail them out. But who do we have to bail us out? Who you gonna call? Your auntie, your uncle, your cousin them? They ain't got enough money to bail you out, right? So the same thing with the crypto market. If they get it regulated and it begins to get traded on the open market, just like any other particular stocks, and it's backed by the US dollar, they can leverage it then, they can hedge it, they can use, they can put it a part of a portfolio and begin to get to a diversified position in it. So, oh, good Lord, I've been talking and saying a lot, and I'm hoping that you're picking up what I'm putting down. So the danger in it is somebody creates this particular investment and they hold all the position of value in it. So if you create an investment and it's not regulated, it's deregulated, and the SEC and the government and nobody else can tell you what to do with it, you can pull you can liquidate your entire position. There's no filings that you got to file with the SEC, the Securities Exchange Commission. And who's to say that you're doing something ethical or unethical when you're the one that owns that particular coin or that particular investment, and you are holding a very large position of its value? Because it's not like through an SEC filing, you said, I'm going to offer this many coins. You could say it publicly all you want, but how do we really know how many you got sitting there that you've really offered? We don't know because there's no regulation and there's no filings or nobody that can check your records and say that's what you really did. So you can issue whatever you want to create the value that you want when you're holding 80% of the value because it's your investment that you offer. Come on, y'all. We need to wake up. How can we be so gullible at times? I say it all the time, and I say to people, I've been saying it for years. I have friends and sometimes coworkers and people. I was trying to get a guy on the show to talk to him so you can hear it straight from him. And I tell people, one of the things that you got to develop a strategy. What's your strategy for going into that investment? What is your strategy? And your strategy just can't be buy low and sell high. That's not a strategy. Come on, let's wake up. And if you want to lose your shirt, your shoes, and your socks, start chasing the green. That's what I tell people. Stop chasing the green just because somebody call you up and say, man, have you seen what's happening to such and such and such a stock or such and such a coin? And you just jump in and start chasing the green. That's the fastest and quickest way to lose your shirt. Don't do that. You got to have a strategy and stick with it. And along with that strategy, have an exit plan to get out of that position, especially if you can't leverage it or you can't hedge it with some type of other alternate derivative. So please wake up, people. Come on, y'all. Let's get smarter, because we got to be smarter when we don't have the amount of money that it takes to really move that needle, right? I'm just saying, unless you come into that position, whether it's stocks or crypto, unless you're coming into that position with a minimum, and even that's still pocket change, a minimum of $100,000 that you can drop on the table all at one time, unless you got that kind of money right now that you ain't got to borrow and that you ain't got to take out a second mortgage on your house to get, unless you got that kind of access to a minimum of $100,000, you ain't gonna move no needle, especially when it comes to an investment like crypto that you don't even have. It's like the savings account at the bank. They say, put your money in this savings account. We're going to give you a 0.00001% return on your money. That's what it's like. You go to the table with like $100,000 and you got somebody over here in a non-regulated position of value that's holding 80% or more of value on something that they control the needle. So that's my opinion about it. I ain't touching this stuff until it gets regulated. And you already see, if you don't believe me, go and find the interview that was done on April 11th with Kevin O'Leary and Kitco News and listen to what he is saying as a major investor, one of the ones that's been speaking out for crypto for the longest. And guess what? They can't even get anybody to agree, or the government or the politicians or whoever, the people that's a part of the Fed boards and all of these, the ones that really are the ones to make a decision to say what's going to happen or what's not going to happen. Those people have not approved anything yet in terms of how this is going to get rolled out. Now, here's another thing. I keep hearing people talking about, hey, well, such and such a bank just bought an X number of coins and this, that, and the third. Well, let me tell you something, folks. When you start talking about institutional investors, they position themselves in advance, number one. Number two, when they position themselves, they've already talked to the whoever, and they have a guaranteed position. Trust me when I say that. Okay, give me an example. I open up my online trading account, right? I see shares of Knickknack going for $10 a share, right? So I go in and I buy 100 shares of Knickknacks at $10 a share. But there's an institutional investor somewhere that says, hey, I'm going to give you $1 million. And if I give you this $1 million, because remember, it's all about raising capital. It ain't just about because people just want to have fun, just practicing, seeing what money does every day. No, it's for the purpose of raising capital to operate a business or to do something, to improve, to expand, to whatever, to make the profit margins look good, to pay off debt, whatever the case may be. So here we are. I bought 100 shares of Knickknacks, right, at $10 a share. There's an institutional investor that says, I'll give you $1 million, but I want to buy these shares at $8 a share. They want that $1 million. They say yes to the institutional investor. Along in the deal, it also says, if y'all don't believe me, go check it out yourself. Go check out everything that I'm saying. All right. They'll say, I want a guaranteed price of $14 a share. So now, not only did they have a buy-in price $2 below what I paid for it, and all I was able to get was 100 shares of Knickknacks, they came to the table with $1 million with a buy-in price of $8 a share and a guaranteed price of $14 a share. So even if it goes above the $14 a share, they still making money. But if it don't, they can sell at any time at their guaranteed price of $14. They can liquidate at that price. That's when you can move the needle, when you are an institutional investor and you're coming to the table with millions of dollars, right? What we have, once again, I'll drop my pen, man. I need my pen. It's my therapy. What we have is like putting 85 cents worth of gas in your gas tank and saying you're going to drive from Chicago to California nonstop. So, once again, develop a minimum of 5 investment strategies. You need to have long strategies. You need to be able to understand. Now you're not going to be really maybe good. Maybe you develop one strategy that you do well or two strategies that you do well, and that's all you do. You're a long type guy. So now, if that's the case, you're going to go into investments that meet your investment profile and your investment strategy of going long. So you're going to go into building your portfolio with blue chip stocks, with the large capitalization stuff, with industry leaders, stuff that's being tracked by the Dow Jones Industrial Average, right? You're going to go into that type of thing, right? If you're a little bit more aggressive, you might sprinkle in a couple international funds or sprinkle in a couple dividend producing stocks or sprinkle in a little bit of stuff that's offered, over the through the pink stocks, over the counter stuff, right? Chances are, though, if you're holding long positions, you ain't gonna really do that, right? Because any of the stuff that's really gonna be increasing in value is gonna be on the Nasdaq or the Dow or something like that. You're not gonna be pink. That's the stuff that you day trade and that you use with short strategies, the pink slips, over the counter stuff, right? So once again, get you some strategies. If you're gonna be trading stocks or whatever, you need to have a minimum of 5 strategies. And I'm gonna say one more thing, as it relates to the stock investing basic. This is basic stuff, man. This is basic stuff. This is the stuff that you need to know. This is like changing a diaper on a baby. This is like boiling the milk at the proper temperature so you won't burn the baby tongue when you stick the bottle in his mouth. This is basic stuff. This is basic 101 stuff. We ain't even talking about advanced stuff. This is basic stuff. So think about it. If they want the crypto to be regulated and based on the market and some type of index or whatever the case may be, backed by the US dollar, right? And you talking about crypto, but you haven't done your research and understand how the stock market works because you think the stock market, one of the people, that stock market's of the devil, the government, and crypto is the new future of unregulated, this is what's going to compete with the US dollar. Stop it. Stop it. Go and listen to that interview and listen to other people. Like I said, there's a reason why Warren Buffett said if you offer him all of it in the entire world, he wouldn't buy it for $25, right? I'm not saying some folks had made some money off of it, but I know just as many, if not a whole lot more, that's lost a lot of money. That's what I'm saying. So here it is. You want to get into crypto, and they want it regulated and indexed on the market, right? Backed by the US dollar. But you haven't done your homework to even understand how the stock market works. So are you going to be proficient at trading crypto in the future if it really does come to that? Like these major investors and these major institutional investors want it to be? Start doing your homework, because the foundation of this country, as much as some folk think that the government is controlling the market, they're not. The business sector controls the market. Let me tell you something else that Kevin O'Leary said in his interview on April 11th with Kitco News. I wrote it down because when he said it out of his own mouth, I was like, whoa. This is what he said. Government, this is what he said about crypto. Are y'all ready? This is what Kevin O'Leary from the Shark Tank, one of the biggest long-standing proponents of crypto, said on April 11th. Go find the article. Go find the interview. It's on YouTube. He said, government should regulate and the private sectors should innovate. So when it comes to the market, that's why when it comes to stocks, right, publicly traded stuff, 53, there's a statistic that I saw that's like, it said like 53.5%. I think it might be a little higher than that, but this is the number that they gave. 53.5% of all the value that's held in the market and investments in the stocks and the market, and all these different types of derivatives of it are held by the wealthy, right? So they're still holding a power position. So if they are using, think about what I'm saying. I'm going to say it kind of slow. If they are using stocks and investments into certain types of businesses and they're holding these positions, because these positions, when they're held in a large volume, large amount, they can hold these positions of value, right? Move the needle 2% and make what we consider to be a lot of money, but still to them is pocket change, right? They hold this position as leverage. Then they'll hold cash reserves, they'll hold real estate, right? They'll hold different types of investments, all within the spectrum, from bonds to stocks to individual corporate funds, government issue type bonds and state issue type bonds, REITs, real estate investment trust type fund. They'll hold this vast array and portfolio of stuff that's in the market. Then they'll leverage it. So a lot of them will hold some gold and some other commodities and futures and stuff like that, but they'll leverage this position because they're holding long, because along with maybe the gold and the silver and the real estate and these leveraged positions in the market, they're able to not only to stabilize their wealth, they're able to continue to grow their wealth, they're able to manage their wealth, and they're able to pass their wealth to the next generation. So they're holding heavy, strong positions in the market. Positions and stuff where a lot of us are saying we're scared, we don't want to do. The market is manipulated and controlled by the government, blah, blah, blah. They're holding positions in the market, in stocks, in bonds, and all these different forms of investments in the market. And they're leveraged in those positions because that leveraged position sustains their wealth as well as it diversifies. It gives them a diversified position while they hold other things like real estate, but they continue to have their business. That's why wealthy people, they don't ever retire, because they still have things that cash flow, whether it's real estate or it's their business or whatever the case may be. They still have things that cash flow. While they're holding these positions, it helps to sustain and it helps to leverage their wealth. If y'all don't believe anything that I'm saying, go look it up for yourself. Go really do your homework, y'all. Come on. I'm just here. I'm not getting paid to do this. I ain't got no advertisers or no sponsors. It's not like I got my Cash App on the screen. So I ain't getting paid to do this. Ain't nobody giving me nothing. I'm just trying to help you. Do your homework, research, man. Research. And by all means, go and find that interview by Kevin O'Leary, who's on the Shark Tank, a major investor, a venture capitalist, which means that's all he's doing is looking for things he can invest in so he can make money. And he wants to make money off of crypto by getting it regulated. Stocks and crypto investing 101. Learn the market. Understand the market. You don't have to learn it and understand it and be proficient in different types of strategies and develop. Once again, I'll say it. I'll beat this dead horse until he wake up and start galloping down the field again. I'm going to beat him till he get up. Develop you at least 5 strategies on investing. You got to know how to understand how stuff is traded short and long. You got to develop you 5 strategies, and by all means, have you an exit strategy. And by all means, don't ever fall in love with something so much where you won't dump it if you have to, especially if you're holding a position where you have not leveraged yourself and you're not hedged in that position. Yes. So thank you for watching this video. Oh my God. How long was I on today? I don't even know how long I've been on. I don't even know how long I've been on. I could talk about some more stuff, but I'm not going to get into that yet. I'm waiting until I get my guest on, the guy that I've been talking to. I've talked to him again this week. We're trying to come up with a time that he can come on and we can go live. Y'all want to see the extent of my notes? This is it. You can't even see it on the screen. Good Lord. No, I'm sorry. You can't see it on the screen. It won't show you, but it's one page. These are my notes. Like I said, I'm not getting paid to do this. I have no sponsors. I ain't even put my Cash App on the screen. Y'all want my Cash App so y'all can help my brother out? Y'all want my Cash App? It's the $sign and then Sneaker Struggles. Sneaker Struggles. $sign Sneaker Struggles. If you appreciate this content, yeah, send me a Cash App to show me that you're getting something of value out of the things that I'm sharing and talking about. Yeah. And once again, if you missed it earlier, look, when you're talking about investing, and you're talking about investing in stocks and all this stuff, by the time you read it on Google or read it on the internet, like we say back in the day, we used to have to read the newspapers. It's old news, y'all. It's old news. And here you are taking your hard-earned dollars off of something that you read on the internet without doing a comprehensive analysis. And you're taking your hard-earned money, going into your savings, and buying something off of old news. Come on now, stop the insanity. By the time you read this stuff on Google, it's old news. The institutional investors, the people that can move the needle, the people that can put $100 in their gas tank and not blink, they're the ones moving the needle. By the time we see it on Google, read it in the newspaper, it's old news. So educate yourself. Come on, y'all. Let's educate ourselves. Let's get smart. Let's really understand the market. Begin to do research. Read some books. Read The Millionaire Mind. Read The Millionaire Next Door. Read The Richest Man in Babylon. Come on, read some books and get your knowledge up. And don't just talk about my investment strategy is buy low and sell high. That's not a strategy. That's foolishness. And then to give that advice to people and they think that's great advice, get out of here. Come on, y'all. Taking your hard-earned dollars. You might as well just go ahead and get another credit card and run it up to the max with that level of thinking. Did I say press the heart button? Please press the like button. Share this video. Let's educate ourselves, y'all. Let's educate ourselves. If you're watching via YouTube, subscribe to the channel. Press that thumbs up. No, thumbs up on there. Drop some comments below and ring that bell so you can get notified when I upload new videos. And if you've been watching via Facebook, press that thumbs up. I see some thumbs ups and some hearts. Thank y'all, man. I appreciate y'all. Y'all drop some comments. Let me check. Let me check if I see some comments. And I don't see any comments yet. It might be some, but I'd have to go and check, but I will go back. If you have some questions about anything that you've heard in this content, drop them in the comment section. I'll do a video and we'll shout you out personally. We'll shout you out by name if you got some questions, and we'll answer your questions on a live video. And maybe we can start getting some people to have that level of interaction. Because I know there's a lot of people that's watching the videos or start watching, but they're not pressing the like button yet, so I can't really see who's watching unless you press the like button, right? Or unless you share it, and I can probably go back and see, the people that have shared the video. But yes, definitely if you're watching via via Facebook, share this content, man. I know you got some friends and family, some aunties, some cousins, some uncles, your daddy, your mama and them that need to hear this information. I'm going to say this statistic one more time. In America, according to Black Enterprise and Entrepreneur in America, Black people in particular, we only hold, according to those sources, 2% of millionaires. 2%. 2%. But yet, go and do the research. If you don't want to double check my numbers, 2021, Black people in particular, we have $1.6 trillion of buying power. Caucasian, white people, number 1. Latinos are number 2. And we are number 3 right behind them at $1.6 trillion buying power. But we don't have the knowledge. We're not educating ourselves, and we're not using our money to build wealth, legacy, generational wealth, financial legacy for our families. We got to get smart, and we can't keep running around saying stupid stuff like buy low and sell high. And that's the extent of your investment knowledge, you will be walking around butt naked because you've lost your shoes, your socks, your shirt, your pants, and your drawers. You've lost everything talking crazy like that, if that's the extent of your investment knowledge. Let's read some books. Let's educate ourselves. Let's start listening to Warren Buffett and what he's saying, and listening to Kevin O'Leary, and listening to these big time people that move the markets, that are the investors, that are the ones that all they do is look around and find stuff to invest in, and then they give their money and put it in there. All right. Thank y'all for watching. This has been James Hollingsworth on the Working People's Podcast. And I love y'all, man. Press that heart button. Press that thumbs up button, right? Share this content. Share this video. You've been watching the Working People's Podcast. And guess what? I'm out.